Most people think their retirement money is boring, slow, conservative, parked somewhere safe. That's the story we tell ourselves so we can sleep at night. But here's the uncomfortable truth. A growing chunk of your pension money is no longer sitting quietly in bonds and blue-chip stocks. It's being pushed into something that looks less like long-term investing and more like a casino that never closes. You don't see the flashing lights, you don't hear the slot machines, but the risk is very real, and it's happening right now. Not because someone is stealing your money, not because of a secret conspiracy, but because the system quietly changed and almost no one noticed. Let's start with why this suddenly matters. For decades, pensions worked on a simple promise. You work, you save. The fund invests cautiously. You retire. That promise depended on one thing above all else: predictable returns. Government bonds paid enough. Big companies grew steadily. Interest rates did the heavy lifting. A pension fund didn't need to be clever, it just needed to be patient. Then interest rates collapsed. Not overnight, slowly, year after year. What used to pay 5 or 6% drifted towards zero. In some places, it went negative, and that broke the math. Because pensions don't have flexible promises. They can't tell retirees, sorry, the market was boring this decade. They owe fixed payments on fixed schedules for decades into the future. So when safe returns disappeared, pension managers faced a quiet crisis. They had obligations that didn't shrink, but returns that did. And that's when the system began to change. At first, the shift sounded reasonable. A little less bonds, a little more equities, some diversification. Then it went further. Private equity, private credit, infrastructure funds, real estate with leverage. Still respectable, still defensible, until one line started appearing more often in pension reports: alternative strategies. That phrase is doing a lot of work, because alternative doesn't just mean different. It often means illiquid, complex, and opaque. Assets that don't trade every day. Assets that don't get marked to market in real time. Assets whose prices are interpreted. And that's where the casino feeling begins. Not because these investments are inherently evil, but because of how they behave under pressure. Let's simplify how this works. A pension fund needs, say, 7% per year to meet its promises. Safe assets give it 3%. That 4% gap doesn't disappear, so the fund goes looking for yield. Private credit offers 8 or 9%. Private equity promises double-digit returns. Structured products smooth volatility on paper. The pitch is always the same: low correlation, sophisticated risk management, long-term horizon. And to be fair, sometimes it works in calm markets. But pensions don't live in calm markets forever. Here's the uncomfortable mechanism. Many of these assets don't reprice when markets wobble. They reprice when deals close, when valuations are updated, when someone finally admits reality. Which means losses arrive late, not slowly, all at once. That delay creates the illusion of stability. While public markets swing wildly, private portfolios look serene, steady, reassuring, until they're not. And because pensions are massive, they don't move quickly. They can't sell everything tomorrow. They can't unwind positions without consequences, so they're locked in. Now layer in leverage, because yield alone often isn't enough. Borrowing boosts returns. It also magnifies losses. This is where the casino metaphor becomes uncomfortable, not because anyone is pulling a lever for fun, but because the odds are quietly shifting. The system starts relying on things going right: credit staying cheap, liquidity staying available, markets staying functional. And when those assumptions hold, everyone looks brilliant. When they don't, the losses don't stay contained. Here's the irony. Pensions moved into these strategies to reduce risk, to stabilize returns, to smooth outcomes. But by chasing yield in a low-rate world, they've tied retirements to more fragile parts of the system. Private markets that depend on refinancing, deals that assume continuous growth, structures that haven't been stress-tested in decades. This isn't theoretical. We've already seen glimpses. Funds freezing withdrawals, valuations quietly marked down months after public markets crash, emergency liquidity lines arranged behind closed doors, and each time the same reassurance follows. This is temporary. Long-term investors will be fine. Volatility is normal. Which may be true, but pensions don't experience volatility like hedge funds. They experience it as delayed consequences. Because retirees don't get to wait for a 10-year recovery. Payments go out every month. That creates another tension. If markets fall and contributions don't cover payouts, funds need cash. They sell what they can, which usually means liquid assets first. Stocks, bonds. The illiquid stuff stays put. So over time, the portfolio becomes even more concentrated in the hard-to-sell assets, the very ones that looked safe because they didn't move. This is where the casino analogy stops being dramatic and starts being mathematical. The house doesn't need everyone to lose at once. It just needs enough pressure at the wrong moment. Now zoom out. Pensions aren't small. They're some of the largest pools of capital on Earth. When they shift behavior, markets feel it. More money chasing private deals pushes prices up. Higher prices compress future returns, which forces even more complexity to hit targets. It's a feedback loop. And it doesn't announce itself with a crash. It shows up as fragility, as dependence on central banks, as emergency facilities, as rules quietly adjusted to prevent forced selling. Each fix makes the system look stable. Each fix also raises the stakes, because the longer losses are delayed, the larger they become when recognized. And here's the quietest, most uncomfortable part. Most people have no idea this is happening. They see a pension balance, they see a statement, they assume safety. Not because they're naive, but because pensions are built on trust. Trust in professionals, trust in diversification, trust that someone, somewhere has modeled the risk. And they probably have. But models don't remove risk, they repackage it. So the question isn't whether pensions are gambling. That's too simple. The question is whether a system built for slow, predictable returns can survive in a world that no longer offers them. Whether hiding volatility actually reduces danger or just postpones it. Because casinos are dangerous, not just because people lose. They're dangerous because they make risk feel controlled, managed, contained, until it isn't. And when the money on the table isn't discretionary wealth, but future livelihoods, the margin for error disappears. So here's the unresolved question. If your retirement now depends on private markets staying liquid, credit staying cheap, and volatility staying polite, what happens when one of those assumptions breaks? And who absorbs the loss when the casino finally shows its hand?